Welcome back, everyone, to another episode of the Anatomy of the Trade. And today we're going to discuss the trade in metals, specifically in gold, through different assets and through different vehicles. Specifically, we're going to look at the trades that France conducted or is conducting in Junior Gold Miners Index, JNUG, and in Junior Gold Miners ETF, GDXJ. So let's look at this right away. So, Franz, please walk us through this trade.
Hi, Roman, and first of all, welcome back. Wyckoff Nation definitely missed you. Hope you had a good vacation.
Well, thank you.
And we're glad we're back in the saddle again here. So this JNUG is a leveraged. I'm sure many of our listeners are familiar with it, but it's a leveraged asset that gives 2 times the return of the underlying index, which is the Junior Gold Miners Index. There's another ETF, GDXJ, which tracks the Junior Gold Miners Index 1 for 1 and is actually an ETF. This investment, this JNUG, uses futures, so it has some interesting characteristics, and it's not something that you want to go through a trading range with, first of all. And by the way, none of what we're going to talk about is trading advice. It's just my own experience and what I've gone through and what I'm seeing right now and what Roman and I are seeing together. But JNUG is a leverage vehicle, so it gives 2 times the return of GDXJ on a daily basis, but it's got a lot of potential decay if you're riding it through a trading range. So it's definitely a vehicle that you want to be in, either if you're a day trader, it's fine, or from a swing perspective, you want to be in it for the trend, but not, you definitely don't want to go through a trading range with it if you can avoid it. So after the history of this for me was after the big drop in March, we obviously had a selling climax, and you can see all of the characteristics. Volume picks up, huge spread, and then we get a nice bounce. And you'll notice my notation there did not recognize automatic rally behavior, did not set risk control stop on initial position. So just, smack me in the face for doing this. But here I am, not even the first day of the rally, the second day, almost at the top of the automatic rally, I get in at 117, okay? And I don't put any stops under it. So within probably 15 minutes, I've been proven wrong, and within 3 days, I've been proving extremely wrong. We go all the way back down to the bottom of the trading range, which is becoming a trading range, and it does exhibit the spread shrinking. We're getting very, very high volume, and on these derivatives, the volume isn't necessarily a perfect indicator, but it works pretty well. But you can see that fewer and fewer people are getting out of this. After the second test, we look like we've kind of made the low. We make a higher low, and now we're starting to trend higher. So things are starting to look better. We get interesting. We don't get nearly the same kind of daily bars in this new trend that we got in the automatic rally, which is sort of an interesting thing to keep in mind in the future. If we get another one of these types of sell-offs, you want to get in and out on the automatic rally if you're going to trade it at all. But we're in this uptrend. We go up through about the end of May and reach a consolidation zone. And Oh, the other thing I forgot to mention is one of the reasons why the volatility is so high back there is that this was initially a 3 times leverage vehicle when I got into it, and the manager of this particular investment came along and said, hey, there's so much volatility, we can't manage this for 3x anymore. We're going to cut it back to 2 times. So that was another unpleasant surprise that happened while this was occurring. But so that's another reason why the daily spread on these bars is not as dramatic, in addition to just the overall selling, if that makes sense. But at any rate, we go through this consolidation area from about the end of May to about the end of June. And I've been in this before, and one of the things that, and actually I use this for another one of our anatomy of a trades, and one of the things that Ramon pointed out is typically once you get a major sell-off and things turn around, the kickoff is not usually the end. There's usually a consolidation range, a consolidation period, and then you generally get another move out of that. So I was keeping that in mind, which is why I didn't sell in this first consolidation pattern, because I was, going on what you told me in the past, Ramon, which is the end. We trade and had another nice move up from 100 to just shy of 200 at the top there, where it broke out and where it ended up. Well, the second time, the second trading range, I was watching this pretty carefully, watching for some sort of climactic action, because I knew I don't want to go through another trading range at this point. So I'm looking at this climactic action. There's that one initial, I guess you might want to call it, you might be willing to call it initial preliminary supply that comes in around the 25th or so. You get another move up, and then starting to get a little bit of a change of behavior there. You can see there's 3 testing bars that get resolved to the upside on one more wider spread up bar that's just early August, and then you can see that that's kind of it. You get an attempt to up thrust right there, and it fails. You pull back, and at that point I said, okay, this is my exit. So I got out, and I think the exit timing was pretty good. If I'd had a good entry, it would have been a great trade. As it was, I made some money on it. But at any rate, that's the history, and some mistakes, and I do feel pretty good about the exit. So
Okay, all right.
plus on that.
So what was the original intention for the trade?
With these leveraged investments, my sense is that with the huge cause that the whole precious metals complex has developed since 2016, we're in for a big campaign type move eventually. And this vehicle, you don't want to hold it through consolidate. So this is my way of trading around my core position, which is in those other ETFs that aren't leveraged, which just benefit from the overall trend. So this is sort of a swing, sort of a when we get these nice trending moves, be in it, and when the trending moves out, get out of it and wait till the next
All right.
trend
So
continues.
it's a swing trade with an idea that this is a long-term, secular type of move.
Right.
Okay, well let's dive in into this. So entry obviously just miscalculated, and I understand. I mean, like at that moment in end of March, mid of March, that was crazy what was going on, and we could feel emotionally even compromised, to deliver the best trades possible. There is a lot of money to be made, in the volatility and the way directionality as well. And obviously sometimes we could just jump into the incorrect asset or into the asset at the incorrect time. And I think this is kind of like exactly what we're seeing here. The best way out of this is just to think through the structure, right? So we have a capitulation into the low, so therefore the first move up will have to be tested. Even though it shows that change of behavior, obviously we want that volatility to be tested and volatility to go down, which we see on this high-low reaction. How could we possibly mitigate that entry at that point of time? And Franz, let me ask you this question. I mean, obviously there were no stop losses, but was the position size a full position size, or was it just one quarter or 1/3 or 1/2?
Yeah, it was I'm trying to remember. It was just it was the maximum that I would have had in this particular vehicle to trade around, but it was a small piece of my overall.
Right. Okay, and then where would be the stop loss?
The stop loss would be under the low of that bar.
Okay, so this, if you lose this position, if you close it as the price goes down, so what would be the percent of the loss on your portfolio? This particular position.
In my portfolio, 1/4%.
1/4%. Okay, yeah. So and this is relatively low. I mean, like even by institutional standards, this is not necessarily fully sized position at 1/4%. So I think that my preference here, just tactically, would be to honor this stop right here and just to say, listen, I was just wrong on execution. I didn't see that this was climactic, and then I changed the behavior and went into the automatic rally. And I just need to get out. So what that would do, it would do two things. It would clear your mind, for the next setup, which would be more beneficial. And secondly, it would give you probably a better price entry. So let's just say that we did exactly that, right? So now we don't have this position. When would be the next time that we would consider this position? Well, probably somewhere here in this area. Why? Because the volatility just went down. We just had the first, secondary test, the testing process, and then the high-low test comes on low volatility, and now we have the reversal. So it seems like this could be the next trade that could be initiated. And then kind of like a cascade of potential entries. One is here, one is here, one is here, then one is here, and especially in this area right here, once we recognize some kind of trading range and we're assuming that this is a reaccumulation trading range, then we are extremely interested in this vehicle right here. I think that the exit that you had relative to this entry would be perfect. So, I mean, if we're discussing just a swing trade right here, this is exactly the up channel for this swing has been broken. So that was a good exit for that particular swing. So I think that maybe a mistake, I mean, obviously it looks like an analytical mistake, but it's also executional mistake in a sense that would we have closed out really quickly and regrouped, and it's only 25 basis points of our portfolio, so it's not a big deal. But if we regroup and we get in around 50 and then around, let's say, 80 and 100 for the second time, that probably would be, kind of like a solution out of this trade.
Well, can I go back and clarify something?
Yep.
The risk is 1/4%, but the position is 5%.
The size of the position is
The
5%.
size of the
Okay.
position is
Yeah.
5%.
Sure.
Right now, I'm at the maximum. My portfolio. This is just my own guidelines, but I've got 35% of, before I sold this, which was a 5% holding. I had 35% of my portfolio allocated to the precious metals complex, which is pretty healthy.
Okay, well, let's look at the next trade because you're trading this theme, the metals, in a different way. So here we're looking at the junior gold miners, um, and walk us through the points of entry and where are you right now and your current stop losses.
Okay. Well, first of all, when you look at this pattern, I think anybody looking at this can agree that this is a substantial cause. It's all the way back to 2016, and Bruce Fraser, the PNF expert, has done some counts on a number of these precious metals areas that show a significant, I mean, huge upside potential for a campaign type of approach. So that's what I'm thinking in this initially. And I'm looking, where I got in was back in November of last year, right on that up bar right there, where we broke out of that range, and it looked to me that that was an LPS that we're getting ready for this trend to start. So all of my except for the leveraged positions were entered there, and things started to work pretty nicely. And then all of a sudden along came COVID, and we can't forget that that's also when oil prices collapsed. So there were some questions about the overall economy as well, but very, very rapid recovery. And once we recovered the support area, I was pretty comfortable that, this is a move that you just want to stay with. And we look at this rally. I mean, from what we have, two commitments on a weekly basis below, and really one of them is only looking serious because the other one's already starting to come back below the support line that goes all the way back to 2016, and then we're through that. Within another couple of weeks, we recovered the means. We're past the halfway level of the trading range, and within another 3 weeks, we're back to the resistance of the, at least not the entire range, but we're back pretty close to where we went down from. So we've recovered the entire loss. Then we have that little pullback area, which is always your gut check, but there is, if you look at what was happening with volume and through that, there's just not a whole lot of selling going on, and there's no real ability. The intention might be to take you back down through the resistance, which has now become support, that heavy green line, and it just doesn't get you anywhere. And there's one scary beginning of the week where that spring occurs, and then it's a spring. Look what happens after that. So then we get this really powerful rally that has some climactic, at least in the near term, look to it. And there's just a lot of,
Okay, so in the stop losses, Franz?
Okay, so my stop losses, what I'm doing with my stop losses now is I'm using the significant bar approach. So every significant bar has a tan colored line under it, or a combination of significant bars. And the rule is that we want to have our major stop loss, the second significant bar, the bottom of the second significant bar away.
So if the price goes down through this level, which is about 54 and a quarter, maybe 54 and a half, so that's just going to be the exit point.
Well, that's the first significant bar. The second one is that 48.66 level.
Okay.
So that would
Below
be,
50.
and that would be an indication that this is not just a a temporary consolidation that's happening, but major sign of strength typically is followed by backing up action. And backing up action can be anything to just a horizontal consolidation to a fairly significant pullback that takes you back into even the top of the trading range.
Okay.
So
all right. Well, let's go through this really quickly. So point of entry, I actually don't have any problems with point of entry, especially pre-COVID reaction, because indeed you have the causality, you have indications of the possible phase C, you have multiple minus sign of strength, and you're thinking here either LPS or backing up action. So I think it's a valid point of entry, especially thinking about what gold has been doing in 2019. Gold has been a little bit better in that regard. If you would have entered gold here, you still would have that COVID reaction to go through. So you're not really protected there, but gold was behaving a little bit better here. Two scenarios. Again, if you could withstand that type of reaction, if you have that conviction that this is going to materialize into a long-term accumulation and it doesn't jeopardize this type of move your portfolio in a significant way, yeah, kudos to you. You could definitely go through this like Franz did, and I know a lot of students actually do that. Tactically, second potential way of dealing with this is something that what we've done, on the previous trade, and that is, let's say if the stop loss is somewhere here, we're getting out and then we kind of regrouping mentally, and hopefully getting in a little bit at a better price, let's say around 30, around 36 as a second entry, 42 as a third entry, just basically trading the swing. So that could be an alternative, to what was done here. Now, in terms of where we are, yes, definitely a major sign of strength that overcomes significant highs, and that is suggestive that this is bullish, this is not an upthrust, and even though we might have some kind of backing up action, it might either be flat or might go to around 50 and then recover from there. Whatever it is, we're still considering a long-term uptrend here. And obviously, if we're using the stop losses, especially in this area right here, and even this one at around 50, we're assuming that we've been riding this wave right here. And, if the price goes down, it touches 50 and we are out, and then it consolidates, we will have to recognize, some other points of entry in the future. Okay, well, this is the weekly chart. Let's look now at the 4-hour chart of this same instrument. And very interesting analog here, how the reactions are unfolding, Franz. So walk us through this.
Well, what I did is I went to the first analog, which turned out to be a reaccumulation, and looked at, first of all, the move into it, which is 1, and then I went to the second reaction, or the second period where we are now, and just tagged each of them, 2 and 2A, the exact same swing. 3 and 3A looks the same. 4 and 4A. and then 5 and 5A and 6 and 6A, which is where we find ourselves right now. And so what kind of observations I was making on this was that the everything's looking pretty comparable up until 4A. And 4A looks a little bit more bearish. And then 5A versus 4, 5A versus 5, you can see it doesn't get back. That center dotted black line, dark line in each range is the mean. It's the linear mean of the trading range. And in 5, it recovers through that and goes all the way up to the resistance of the trading range. In 5A, it upthrusts the mean and heads back down. So looks a little bit bearish. Volume really isn't too terribly threatening, but there is an increase. And so I'm thinking, okay, what if we even have some of that backing up action? I don't want to lose my overall position. So instead, what I'd like to do is hedge my positions. So I'm actually using a vehicle, JDST, which is the inverse of the mining stocks in general. And I'm using that right now to protect myself on the downside. Instead of what Roman was talking about, which is, just getting out of the position, then having to figure out how to get back into it again. I'm just going to stay hedged and see how this works out. If it goes down, at some point I'll have to take the hedge off because I think it'll turn around and go back up again. If it becomes more bullish through this trading range, if this is another accumulation and it breaks out, then I'll just take the hedge off, and I really won't have given up much. So I feel, like for me, it's a good approach because I do want to stay in this for the long term. I think it is a campaign type of vehicle.
Okay.
That makes sense.
Well, when we look at the analogs, what is important? Whether the analog is going to work itself out of, let's say, consolidation, or it doesn't. And when the analog structural analog is being broken, so let's say that we go and attempt to go up, and then there is a failure. So this failure right here would be significant because the price structure is now no longer behaving the same way. So that would be a very interesting, signal on its own. But obviously, our first assumption is that we're going to resolve the trading range kind of in the same manner. So we would be looking here for another possible test, something like this, and then the next sign of strength, overcoming, let's say, this area, maybe even this one, another backing up action, and then continuation up. If we see this type of action, we would be thinking about maybe even adding to the position if we are, still bullish long term, which we are. Or if the pattern fails, obviously we want, those hedges to start working, or we want to scale out more, or we want to establish, more of a short-term type of directional position. But the structure is very interesting because the waves are developing kind of in the same way. All right, well, very interesting observations. And Franz, thank you so much for showing us what you're doing with metals. I'm sure we will come back to this. We will review not just gold, we will review also silver in the near future. We're just coming back from, a vacation break. So we'll get into different parts of the market. And thank you guys for listening to us, for watching our episodes. Send us an email to wyckofassociates@gmail.com. Suggest what you would like to look at. We'll gladly do this. Franz, thank you so much.
Thank you, Roman. Thanks for coming back from vacation. And sorry I had to do so much talking today, but
you did well.
Anyway. Okay.
Thank you, guys. See you next week. Bye-bye.